I would like to take 30 seconds to talk about this disclosure. A lot of what I'm going to say may be perceived as negative and damaging to Wayfair, but this video is for entertainment only. I'm not a stock analyst. I'm not a financial advisor. I'm a financial analyst, but these videos are for your entertainment only, not recommendations or professional analysis. Wayfair is an American e-commerce company that sells furniture, home goods, and decor online. It was founded in 2002 and is headquartered in Boston. The Wall Street Journal reported that Wayfair lost 5 million customers in 2022, shrinking the shopper count to near its pre-COVID-19 pandemic size. For the last 4 quarters, Wayfair has lost over 300 million each quarter. The stock price of Wayfair was once over $300 per share in 2020. Currently, it is less than $40 a share. Revenue was over $14 billion in 2020. This dropped to $13.7 billion in 2021. In 2022, it was $12.2 billion. The cost of revenue is relatively significant. What little gross profit is generated is usually consumed by operating expenses. The last time operating income was positive was in 2020. Selling, general, and administrative costs are high. SG&A referred to the expenses that a company incurs in its normal operations, which are not directly related to the production or manufacturing of goods. SG&A expenses include sales and marketing expenses, general and administrative expenses, research and development expenses, and legal and accounting expenses. Wayfair has over 20,000 suppliers. Having too many suppliers can be bad for several reasons. Increased complexity, higher costs. Having too many suppliers can lead to higher costs, as it can be more expensive to manage and maintain relationships with a large number of suppliers. This can also make it more difficult to negotiate favorable pricing and terms with suppliers. Quality issues. Working with too many suppliers can make it more difficult to monitor and maintain quality standards. This can increase the risk of receiving defective or low-quality products, which can damage a company's reputation and lead to customer dissatisfaction. Supply chain disruptions. Having too many suppliers can increase the risk of supply chain disruptions, as it can be more difficult to manage the flow of goods and respond to unexpected events. This can lead to delays, shortages, and other issues that can impact a company's ability to deliver products to customers. Overall, having too many suppliers can make it more difficult and expensive to manage the supply chain, increase the risk of quality issues and supply chain disruptions, and reduce a company's ability to negotiate favorable pricing and terms with suppliers. It is generally better for companies to work with a smaller number of reliable and high-quality suppliers to streamline their supply chain and minimize the risks associated with managing a complex network of suppliers. While marketing is essential for promoting a company's products or services, spending too much on marketing can have negative consequences. Here are some of the reasons why it can be bad to spend too much on marketing. Decreased profitability. If a company spends too much on marketing, it can reduce its profitability. Excessive marketing expenses can cut into a company's profit margin, which can impact its ability to invest in other areas of the business. Diminished brand value. Overspending on marketing can create an image of desperation, where the company is seen as trying too hard to sell its products or services. This can diminish the brand value and undermine the long-term viability of the business. Ineffective use of resources. If a company spends too much on marketing, it may not be using its resources effectively. It may be overspending on certain marketing channels while neglecting others that could be more effective in reaching its target audience. Diminished customer loyalty. If a customer overspends on marketing, it may not be focusing on building long-term relationships with its customers. Overall, while marketing is an essential part of any business, it is important to balance marketing expenses with other areas of the business and avoid overspending on marketing. A strategic and well-planned marketing budget can help a company effectively reach its target audience and achieve its business objectives without sacrificing profitability or long-term brand value. Items are bulky, heavy, and easily damaged. The home goods and furniture business is hyper-competitive and profit margins are thin. If there is further economic distress and turmoil, companies like Wayfair will have much fewer sales. Customers typically cut back on discretionary purchases during a recession for a variety of reasons, including decrease in disposable income, uncertainty about the future, prioritizing essential expenses, and fear of debt. Overall, during a recession, customers often cut back on discretionary purchases in order to prioritize their spending and reduce their financial risk. This can have a significant impact on businesses that rely on these types of purchases, as they may see a decline in sales and revenue. Stockholders' deficit, also known as shareholders' deficit, is a term used to describe a situation where a company's liabilities exceed its assets. In other words, the company owes more than it owns. Having a stockholders' deficit is a cause for concern for investors, as it indicates that the company may not be financially stable and may not be able to meet its obligations. It can also make it difficult for the company to raise funds or attract investors. Customer reviews. Customers commonly complain about Wayfair due to shipping delays, low-quality products, poor customer service, frustrating returns process, and uncompetitive pricing. I reviewed dozens of customer reviews and I noticed some trends. When a customer requests a refund, Wayfair may not always honor it, instead sending a replacement when no replacement was requested, Exhibit 1. I saw reviews where Wayfair agreed to allow the return of merchandise only to run out the clock on the 30-day return policy, so the customer was stuck with the item, Exhibit 2. There may be missing hardware, Exhibit 3. Wayfair may agree to pick up the furniture you want to return, but the truck never arrives on the agreed-upon day to pick up the furniture, Exhibit 4. The furniture is of poor quality, Exhibit 5. Products may be received damaged, Exhibit 6. Your order may not arrive on the date that they stated, Exhibit 7. The order that you receive may not be correct, Exhibit 8. The order may come in multiple shipments on multiple days, Exhibit 9.